Hello and welcome. You are watching News9. I am Suyash Maheshwari and to my right is Shweta Kothari. And you're watching Business Plus, where we cover stories from the world of business, policy and economy. As always, let's start with taking cues of the market mood this morning. Now, after a 1% fall in the last 2 days, Indian markets saw a bounce back amid positive handover from US equities. Indian markets, in fact, saw a gap up opening where Nifty was, up about 100 points and Sensex gained as much as 350 points. Now, US market snapped its 3-day losing streak yesterday with Nasdaq rising as much as 1% after US 10-year bonds eased slightly. Also, a fall in crude prices as well as lower than expected jobs data, the private jobs data in the US lifted sentiment for the equities as talks about a higher rate regime for a longer period has eased, and as a result we saw a bounce back in the Indian markets also, Shweta. Now Nifty currently is trading above the 19,500 levels, which was and
back
has
at its
been
crucial support
level, and whereas Sensex has scaled about 360 points this morning and it is trading about 65,587 points thereabouts.
All right. So
now the broader markets, Shweta, have also been buoyant. Now they saw a correction of over 1%. Nifty mid cap was down about 1.5%, whereas small cap index corrected by 2%. Today morning the small cap index is up about 1% or so, and the Nifty mid cap indices, mid cap 100, is up about 0.5% in the morning trade.
all right, so that's as far as markets this morning is concerned. A gap up opening in the markets. Is this a rally? Is this a much awaited rally? I mean, come to think of it, 0.5% down as of closing day yesterday, 0.5% up today. Markets are beating perhaps all estimates. We had a very important guest, Mr. Baliga, Amrish Baliga, on the show yesterday, who's in fact in a way predicted that markets are going to touch 18,000 mark. Nifty is going to touch 18,000 mark before it scales up to 20,000 once again. Ashish Maheshwari, I'm told, who's the director at Arihant Capital, joining us on the show at this point. Ashish, good morning. Thank you for taking time. I think first question that is weighing on everybody's mind is, what are you making of this sharp bounce back and volatility?
I think whatever is happening in the global market, we are aligned or in sync with that. So we have seen in last 6 trading sessions, if you see, almost 13,000 crore worth of equities are sold by FIs. And if this momentum will not continue, I think again there will be seller. And if you see the US bond yields, etc., also there's a lot of pressure in the portfolios of US fund managers also to book gains or to liquidate positions, because the bond prices, the way bond prices are going down, they have to liquidate some of their holdings for sure. And emerging markets are the one where they have made money, so some liquidation is coming. We have seen in the last month also a lot of deliveries were sold in cash market, and I'm expecting same trend will continue unless this rate hike related fear subsides in US market.
What are you making of this 0.5% movement and 0.5% up movement one day and 0.5% down movement that's playing out in the markets for the past 4 days? In Friday's session we saw a 0.5% rise. In the last 2 sessions the market was down 0.5%. Today it's up 0.5%. What are you making of this, sharp up moves and down moves in the market?
So this is something like this kind of volatility is happening on account of FI selling in the market. Yesterday also we saw almost 4,000 crores worth of equities they dumped in Indian market, and whenever they sell, they mostly selling come in the basket format. So the impact is quite high. So this kind of volatility will continue because as such there are no domestic triggers also which can keep our stock market going, and unless now because the result season will start. So some momentum is going to be there in individual stock specific stories, but overall still I'm of the view that FIs won't stop selling Indian equities in a short period of time. They will continue to sell.
All right. And how about longer period? When do you see FII's interest coming back to India?
If you see, even all the FI brokerages are, if you see Nifty 50 stocks, almost 80 to 90% are buy side recommendations, be it Jefferies or Morgan Stanley's or you name it. They are all bullish as far as individual stocks are concerned, but this is something like beyond the control, because when you are having a lot of payout you have to make out of your investments in US market, you have to liquidate somewhere. So they are not selling by choice, but I think by compulsion. So we need to just wait and watch, because there's some issues related to interest rate hike in US markets. And once there's comfort in the street that now a rate hike is going to pause, then you are going to see fresh inflows in their funds. And at the same time, they will again start buying into Indian equities. But till that time, we need to just wait and watch.
Now, Ashish, we saw a 5% or so crash in Brent crude prices after OPEC Plus decided to maintain its output policy, and Russia and Saudi said that it will extend its cut of about 1.3 billion barrels per day. So no, there were talks that perhaps there could be more cuts in the offing. As far as at least now, OPEC has come out and said that it will stick to that path. And also the yields came off that 16-year high. So it seems that there is some sort of a relief there. Perhaps that's why the market saw that 0.5% up move today.
Yes, there's the solace at last. The crude, which was almost at $95 for quite some time, has again touched $85, which is a comfort mark as far as the Indian markets are concerned. And this is slight 15 basis point retracement in bond yields is also something that market is playing for by trading in green. But only thing is, till how long this is sustainable, at least the bond yields, which need to be seen. As far as crude is concerned, I don't think so. Now we are going to see $95 back in Ziffy, because the way employment data is expected from US markets, demand for crude is expected to go down only. So I think now next territory for crude trading should be $82 to $92 instead of 85 to 95.
So perhaps a correction of about $5 instead of scaling back that $90 levels. Also,
and this augurs well for India. Come to think of it, Ashish, India, I think the comfort zone that oil minister has constantly maintained is about $80 to $85 a barrel. If the oil prices were to come back within that range, it augurs well for India.
100%, because India is major importer of oil products, and if the oil prices remain in this territory, you don't need to increase retail oil prices at all. As at the same time, in wholesale prices also will be under check. And we should not forget this is an election year, so retail fuel prices, I'm not expecting that they will go up. Only some tapering in LPG prices, etc., will keep on happening. But surely, if wholesale fuel prices goes up, then this is again a problem with the inflation numbers. At this point of time, government is they're doing all proactive steps to tame the inflation hike. So, in my view, our interest rate will remain in this particular territory. I'm not expecting any rate hike, etc. So, crude is an important factor for everything. So. If crude remains in this territory, I think this augurs well for India.
So better inflation, perhaps a longish pause and a rate cut subsequently at some point of time, Ashish, if not this time around. And since MPC, announcement will be made tomorrow, your expectation from what I'm reading is that it's going to be a pause, a hawkish pause?
Yes, a hawkish pause is something like that market is also expecting. And it's going to be there because there's no need to, in fact, do a rate hike as such, because the vegetable prices and the food prices are under control now. And even electricity demand has also come down. So you are going to see some moderation in inflation going forward instead of rise in inflation now onwards. So I'm expecting a pause this time, and maybe a rate cut in the next policy.
Okay.
So you
Rate
expect
cut
a
in the
rate cut in the
next
next policy?
That's very
actually
soon.
quicker than the timeline that a lot of analysts are pitching in, because they expect the rate cuts to set in probably in the second half of the next calendar year.
And some of them not expecting, at least in this financial year, this is as quick as it gets. So you just to reaffirm what you said, you're saying there could be a rate cut by next policy.
So again, the rationale is if the inflation comes down, see,
Okay.
because we are going a growing economy and lower interest rates are good for the our growth as such. So, and one important thing is again I'm reiterating, this is an election year. So government will not like that the interest rate will go up and unnecessary middle class and lower middle class face the brunt of higher interest rate. So this is the reason that like I'm taking a call and that sooner or later you might see some dip in the interest rate cycle, because if inflation is under control, there's no need to keep those higher rates in the economy.
Okay, I'm
But I
still
mean,
hoping MPC will take that decision independent of the government pressure, what government wants. So hopefully, and knowing that RBI is a standalone institution with its own autonomy, hopefully will take a policy call based on what inflationary pressures the country is facing, as opposed to the government pressure that it will face on account of election.
yes, and to that point, I mean, one of the reasons why we are seeing, heightened inflation is probably because of government front loading the capex cycle ahead of the elections. So RBI keeping the policy rates higher to, lower the inflation, whereas government is spending more, which is pushing up the inflation. So fiscal policy
And the
and monetary policy,
quite in contradiction with one another. All
Ashish,
right.
Yes, I
is there a
agree.
play there?
For sure, government is pushing their capex and the kind of budgets they are having for capex in this year in almost all sectors, be it defense or railway or power or infrastructure. I think they will keep some pressure on inflation, but one thing we must understand, if you see the demand for steel, cement, etc., there it is going to pick up, but the prices are not going up because the kind of expansion our Indian companies have done in last few years is keeping price under check. Besides this, there is not too much export demand also as far as all these industries are concerned. So everything is consumed in India, well, without hurting the prices or without hurting any capex plan. So I think this will continue at least for 6 months. I am not expecting steel, copper, aluminum, or cement prices will go up at least in next 6 months. And this is the reason I'm quite bullish as such in overall sentiment that because of this interest rate will come down sooner or later.
Now, as you said, you are bullish on the India story in the short term as well, and you expect crude prices to moderate to, moderate further to about $80 a barrel, inflation cooling down. All that augurs well for the Indian markets. But, we have had Mr. Amrish Balega yesterday, who was of the opinion that perhaps Nifty and the headliners could see some more weakness coming over the next couple of months, and Nifty could, break past that 19,000 mark and fall as much as 5% to 18,500 mark. So in light of all this, like what sort of a probability do you think is there that the market sees a correction of 5% or so play out in the next couple of months?
I mean, do you even agree with that to begin with? Do you even agree that there could be a sharp 5% fall?
If you see it from 19,500 to 19,000, there's hardly 3-4% mark. So this kind of fall, gain or loss are quite possible when you are sitting at 19-20,000 indices. So I'm not going into much what may happen in 19,000 or what will happen in 20,000. I think this all depends on how your this quarterly numbers comes. And I'm not expecting any weakness as far as this quarterly number comes. So you will not keep on dumping stock in spite of good numbers in if these companies come out with. And I'm expecting Nifty companies will come out again good set of numbers, be it IT or oil and gas or banking sector. They will come out with good set of numbers with this in this quarter. So I'm not that bearish. In my view, maybe 19,200 kind of mark in Nifty can be a good support or even a good accumulation zone at this price point.
Ashish, you mentioned that IT could, come out with a good set of numbers in Q2. But, the commentary that came from Accenture last week suggested that discretionary spending has perhaps not picked up just as yet. And, even the smaller projects are facing delays. But in contrast, we have seen, at least the bellwether companies like Infosys, HCL, Tech, and TCS land billions of dollars of worth of contracts in a span of couple of months. So, do you think that Indian IT sector could outperform the global IT sector? And if so, on what basis, pretty much?
First thing is these IT companies, whatever we are having the top IT companies like Infosys, HCL Tech, Wipro, Infosys, etc. They are having long-term contracts and they are more into the support operation of an organization. So like they are managing, implementing the ERP, they are implementing the digital transformation process, they are maintaining their back-end operations, etc. So if an organization is doing business, they have to take services of these companies. So this is the reason, in spite of last quarter weak commentary, still they were able to come out with some really good deals as such. So in my view, like whatever the last quarter weakness was there, slightly we need to discount this, and we are going to see some moderate growth also in this quarter. Another thing which has happened for mid-cap IT companies, in mid-cap IT companies, they are operating very niche areas of working like automations or AI or machine learning or digitalization, etc. So your companies like again KPIT, Tata Elxsi, etc. They will also continue to do well because they are very focused and operating not in 20, 30 verticals, but 5, 6, 7 verticals where growth is there and they are having long-term arrangements. So this is the reason, in my view, this sector will continue to do well and should be in our buy radar.
Now, I also wanted to get your view on the banking SPAC, specifically HDFC Bank. Now, in yesterday's fall, where we saw a 1% correction in Nifty Bank, HDFC Bank was the only constituent stock that did not fall. In fact, it went up by about 1.5%. And HDFC Bank has been a major drag on Nifty and Bank Nifty. And in the recent correction, I think it has attributed to about 192 points of fall. But after yesterday's pickup and the management rejig is also happening, do you expect that perhaps there is a time that HDFC Bank could perhaps make a turnaround in the next few days, sessions or weeks, and it could drive Nifty Bank and Nifty higher from here on?
Yes, I think HDFC Bank along with Reliance was major culprit of bringing Nifty down. And now at 1525, 30 levels, there is a lot of value now in this stock. And if we saw their last quarterly updates also, they were quite robust. In fact, besides home loan, significant growth, again, wholesale banking and corporate banking has also grown quite a bit quarter over quarter. So, in my view, worst is now priced in HDFC Bank. Another issue was with HDFC Bank post this merger. Again, a lot of selling was happening from foreign institutional investors. But at the same time, we have seen again gradual accumulation happening in the stock from DIA side also, because ultimately value is there in the stock. And we have seen upgrades also from foreign brokerages now in this stock with 2000 plus targets coming in HDFC. So, in my view, you have to start accumulating such stocks where fundamentals are strong, but because of excess supply, stocks have fallen. So, this is a good price point to enter into HDFC Bank.
Now, as we are running short of time, I also want to touch upon the World Cup. The World Cup starts today. A lot of sectors, related sectors like hotels, QSR segment,
The
and
consumption
also the
industry.
consumption theory has picked up and has rallied. In fact, the hotel sector has been one of the outperformers in the last few months, as the average room rate has gone on off the roof. And I was reading a report where it suggested that, you know, in cities where matches are going to be played, the average room rate has spiked up as much as 150%. So given that, you know, the revenue at least guidance looks good for these hotel companies, do you think that the expectation of the World Cup and, you know, subsequent festival season and the wedding season that also kicks off in a couple of months has already been priced in, or is there a play that investors can make at this point in time?
So I think this is a sector which will continue to do well. We have seen in the last quarter also the numbers were pretty robust for all these hotel stock or QSR companies, etc. So again, as consumption is picking up, as far as World Cup is concerned, again the hotel stocks are going to be in limelight, because assume there will be a crowd of 45,000 in a stadium, and at least 5,000 people if they start traveling from various countries or various cities, etc. At least you require 2,000 room in cities like Bangalore or Chennai, and that too in decent size hotels. So rooms rates are going to surely go on the roof, and this is going to benefit a lot of companies like Lemon Tree Hotel or EIH and Indian Hotel, etc. So I'm quite bullish as far as hospitality industry is concerned. Though there will be some pressure related to crude prices on aviation stock, otherwise interglobe aviation can be also kept on radar now.
All right, Ashish, thank you very much for taking time out. Thank you for joining us this morning. We, of course, are keeping a close watch on World Cup. We continue to track all the developments there as well. And to you too, Suyash, thank you very much for taking time out.